This is Business Weekend with Ross Greenwood.
Hi and welcome to Business Weekend. I'm Ross Greenwood. Thanks for your company. Coming up on the program today, Treasurer Jim Chalmers says the economy is not headed for recession, but he's wary about the forecasts and the international situation where the US economy slipped for the second quarter in a row this week. The Treasurer is on our program this morning.
I'm actually quite optimistic and quite confident that we can weather the storm together, but there will be some heavy weather.
But the Treasurer will also warn about tougher financial times ahead. The Reserve Bank this week makes its latest decision about the economy and interest rates, and Deutsche Bank Chief Economist Phil O'Donoghue will join us shortly and tell us by how much they'll move. We also know that lots of rules changed during the pandemic, but the head of the New South Wales Productivity Commission says that many of those changes were actually good for us and the economy and should be left in place.
All sorts of rules in relation to that, and to a great extent they help some businesses to get through the pandemic.
Plus, we give you an update on the company reporting season, which starts tomorrow and goes all the way through August. And we'll hear from two of the upstart challengers to the big banks' dominant share of the mortgage market. So all of that and more on the program today. But look, let's start the program by recapping what was a week chock full of economic news, both here and overseas. Edward Boyd wraps it all up.
Recession was the word of the week. It kicked off with the International Monetary Fund warning the global economy is at risk of a serious downturn.
The outlook has darkened significantly since April. The world may soon be teetering on the edge of a global recession, only 2 years after the last one.
Wednesday marked the release of Australia's June quarter inflation number. Our consumer price index jumped to 6.1%, the highest level in 21 years. Construction costs, petrol, furniture prices and food all soared in the 12 months to June. The markets rallied off the back of this data, which gave a hint the Reserve Bank will lift interest rates by 50 basis points next week, instead of the supersized 75 basis point rate hike some had predicted.
The market interpreted this, combined with what's going on, of course, globally at the moment and what's going on in commodity markets, as something that will suggest that the RBA won't have to go quite as hard. We still think the RBA goes by 50 basis points in August.
To show how the market outlook changed, in mid-June, 3-year government bonds had a yield of 3.8%. Late this week, barely 6 weeks later, the rate was more than 1 percentage point lower, around 2.735%. And the fall accelerated after Treasurer Jim Chalmers said Australia seems set for a soft economic landing. He did warn, though, that inflation will get worse before it gets better.
It's already 6.1% through the year to June, and now forecast to peak at 7.75% in the December quarter this year. The current expectation is that it will get worse this year, moderate next year, and normalise the year after.
US Federal Reserve Chairman Jerome Powell lifted interest rates on Thursday by 75 basis points, but at his press conference he fended off suggestions the American economy is currently in recession.
So I do not think the US is currently in a recession. And the reason is there are just too many areas of the economy that are performing too well. And of course, I would point to the labour market in particular.
The next day, the US economy contracted for the second straight quarter, the technical term for a recession. But in America, that pronouncement comes from the National Bureau of Economic Research. President Biden was having none of the recession talk.
There's going to be a lot of chatter today on Wall Street and among pundits about whether we are in a recession. But if you look at our job market, consumer spending, business investment, we see signs of economic progress in the second quarter as well.
From all this, stock markets rallied sharply this week. The ASX reached a 6-week high and Wall Street lifting to a 7-week high. But economists say the storm clouds remain.
If you get recessions in the major growth drivers around the world, and, as mentioned, China's already slowed notably. Their statistics, by their standards, if you like, they're already in recession. If you see that in the US, if you see that in Europe as well, it gets harder and harder to avoid it. in Australia.
Well, Treasurer Jim Chalmers is making a point of being front and centre with the Australian community, and he did it this week when he rose in Parliament, as we saw there, and painted an increasingly difficult period for Australian businesses and households in the period ahead. But the painter he pictured was not as dire as many had suggested. One of the keys for the Treasurer is to control the expectation about wage rises as prices and inflation increase. I caught up with the Treasurer late this week, and asked him whether Australia would avoid recession.
Oh, that's our expectation, Ross, that the economy will continue to grow, but so, for the meantime, will our economic challenges. And what today's economic statement was really all about was bringing Australians into our confidence so that they know the expectations of the Treasury for the future of our economy over the coming months and years as we put together what will be a difficult balance to strike in the October budget.
Okay, as the Treasurer though, what keeps you up at night? What is the worry that you think could really be the vulnerability in these numbers and these forecasts that could lead to a worse outcome?
Oh, look, obviously there's a lot of uncertainty. As you know, probably as well as anyone who's been following forecasting for a long time now, it's difficult to forecast the future of the economy, particularly in volatile times. But the choice that we had to make is whether or not to bring people into our confidence and reveal the economic expectations that Treasury has given us, or to keep them to ourselves. And so I thought on balance, best to release them so that people can hold them up to the light and see what we are dealing with and what we as a country are dealing with at the same time. But when it comes to worries about the risks to the forecasts, I mean, obviously the wages forecast has been difficult for some time. Clearly, there's a lot of concern about the global economy, which I share, frankly, out of China, out of the US, out of Ukraine, and around vulnerable countries dealing with different versions of debt crises like the Sri Lankans and others. And so there's a lot to concern us about the update today. But really what I wanted to say, Ross, to the Australian people via their parliament is I'm actually quite optimistic and quite confident that we can weather the storm together. But there will be some heavy weather for the time being, whether it's inflation, rising interest rates, slowing growth, what that means for the unemployment rate. We are in for some heavy weather, and I'd rather be upfront with people about that so that they know what we are confronting together.
Yeah, so annual inflation of 7.75%, then ultimately rising unemployment from 3.5% to 4%, and then the inevitable rising interest rates that will come. That's where the heavy weather really is. But how well prepared do you think Australian households are to cope with it?
Oh, look, some have a bit of resilience built into their household budgets, and that's obviously a very good thing. Some people have been able to get ahead, for example, on their mortgage repayments, but a lot of people haven't. A lot of people don't have those buffers in their household budgets. And even if they're not homeowners dealing with rising interest rates, the inflation problem itself, it really punishes people who are the most vulnerable. That's why we supported that decent pay rise for people on low incomes, for example, because they are the people who are hurt the most by rising inflation. Inflation, as you know, has the capacity to absolutely destroy household budgets. People are trying to substitute out what they don't need in their budget for the things that they really need. And we're going through a similar process, frankly, at the national level, because our budget, the national budget, has got a lot of debt in it, which is becoming more expensive to service as interest rates rise. And so we've got to make sure that every dollar we spend is going to productive purpose as well.
The other thing that you are aware of is that inflation, high inflation, if it's persistent, ultimately leads to unemployment as employers really make a decision about cutting costs in the face of their own rising costs. And so that's where there is potentially a risk. Is one of the real issues right now is that if wages expectations get out of hand, that bakes the inflation into Australia's economy and it leads to persistently high interest rates, which really do damage Australia's economy and make it vulnerable.
Yeah, well, that concern that you raise, and it's a concern that's often shared with me, is actually the reason why I released those detailed inflation forecasts today, because I wanted people to know that even though we expect, or Treasury expects, inflation to peak at 7.75% towards the end of this year, inflation in their expectation will moderate after that and will normalise the year after. So I wanted to give people a sense not just of the size of this challenge, but the shape of it as well. And because we don't want those inflation expectations to bake in for years, I thought it best to let people know what we thought about inflation moderating and then normalising, because that issue that you raised would be a concern if we were expecting inflation to stay high forever.
OK, but this must also be something of a debate even inside your own party room, because you would have members who would be highly sympathetic to the fact that workers should be getting inflation-style pay rises. Now, given inflation goes to 7.75%, that might be something that ultimately could bake in the inflation long term and ultimately be damaging. How do you balance that up as a Treasurer?
I think all of our team understands that we do want strong wages growth, but we want it to be sustainable. You know, I don't hear anybody in our team calling for exorbitant wages growth. What people really want to see is something that's strong and sustainable at the same time and enduring. And there is a high level of understanding, not just in our side of the parliament, but I think in the Australian community, that one of the problems we've had with our economy for the best part of a decade now is those stagnant wages. We've got real wages going backwards quite considerably at the moment, unfortunately. And so our job is to see that inflation moderate, do our bit on the supply side in particular, but also to get those real wages growing again. I think that's in the interests of all Australians, that as we rebuild this economy after this difficult period, that sustainable wages growth is part of the story. And that means productivity is part of the story. It means investing in the future of our economy, strong and secure, well-paid jobs is a big part of our agenda, because, what we want to see is these wage increases to continue, to endure, and to be responsible and sustainable at the same time.
OK, let me go to your own statement this week, your own speech. He says, we expect that government payments will be around $30 billion higher over the forward estimates that was forecast pre-election because of inflation and wage expectations and how they flow through. The problem I have with that statement is you're almost, predicating or pre-indicating that there are going to be baked-in wage expectations.
Respectfully, Ross, I don't see it that way, and I'm pleased I've got the opportunity to provide a view on it. I mean, the inflation part of it is obviously easy to understand. A lot of government payments are indexed to inflation. The age pension, for example, will go up in September as a consequence of that, and that's a good thing, but that means that the budget wears the heavier cost of that. That's easy to understand. On the wages side, we are actually forecasting, or Treasury is forecasting in these figures today, a moderate uptick in wages growth. And it takes a little while for that to cross over with inflation to get real wages growth. But when it comes to the wage price index, we're actually revising up moderately our expectations for wages today. And so that flows through to those payments, which are indexed to wages rather than to CPI.
One thing you've been saying in recent times, I've heard you say it a number of times, is that not every good idea can be funded. And this actually goes to the area of fiscal discipline. In other words, making certain that you really do look at that spending area inside your budget. There's a second aspect of this also, and that is that right now that budget is in rude health. If I go back to the May accounts from the Department of Finance, they showed that Australia's budget was in surplus in that time. And indeed, over the course of this last financial year, it will be at least $30, maybe $40 billion better off than where it was expected to be. So right now, it's fair to say that the budget's in rude health. It's not necessarily the basket case that maybe many people presume.
Look, there's part of the first part of that question I agree with, Ross, but certainly not the last part of it. I mean, we've got in the budget $1 trillion of debt, as you know, and even with that quite welcome bump that we got from high commodity prices combined with some other elements, which I'll come back to. Even with that, we've still got what will be decades of deficits. And so I wouldn't accept that the budget is in good condition, but I do agree that the budget which finished at the end of June, perhaps the very beginning of this budget year that we're in now, it has been really substantially pumped up by much higher than expected commodity prices, but also the inability to get some of the spending out the door in areas like infrastructure because of this supply chain crunch. And so there has been a lot of revenue from high commodity prices. There has been a lot of spending pushed out of last year into this year and beyond. And that means there will be a dramatic improvement in the budget for last year. That's a good thing in one way, but it still doesn't mean the budget's in good nick. And unfortunately for all of us, particularly perhaps for those of us making decisions about the budget, the things that have been going for us in the budget are not permanent. They're highly temporary, whereas the pressures are more permanent, whether it's those payment pressures or issues around necessary spending on the NDIS or aged care, plus, of course, the cost of servicing the debt itself.
The one thing that is going for you, though, is employment, with 3.5% unemployment rate, with a record participation rate, record numbers of men and women in the workforce right now, and given that the government traditionally has earned around half of its income each year from PAYG taxpayers, I mean, that's the thing that's bumping up the budget along with those commodity prices.
We're very pleased about that. Obviously, that's a very welcome development. Seeing unemployment at around 3.5% is obviously something that we are very welcoming of. It's a very good thing. It's one of the things that we've got going for us in our economy. We've got relatively strong demand. We've got that low unemployment. We've been getting good prices for our commodities until the last few weeks, and all of that is heading in our direction and helping us out in the budget. But unfortunately, we've got much more going the other way, whether it's subsequent waves of COVID, whether it's the consequences of the war in Ukraine, whether it's the China slowdown or fears about the US or the impact of rising interest rates. And that's why in aggregate, the Treasury forecasts I released today have economic growth slowing. That has implications, as you know, for the unemployment rate as well. And these are some of the challenges that we're dealing with and being upfront about.
Treasurer Jim Chalmers, always good to chat to you, and many thanks for your time today.
And you, Ross, all the best.
Well, the Treasurer has given you the clearest indication that interest rates will keep rising to control the outbreak of inflation. The Reserve Bank Board, of course, meets this week with knowledge of the latest inflation rate, 6.1% in the June quarter. And as we heard from Jim Chalmers just then, expected to peak at 7.75% later this year. So let's bring in here Phil O'Donoghue, who is Chief Economist with Deutsche Bank here in Australia. Phil, always good to have you on the program. The Reserve Bank now has got to make its response based on the information it's got, plus also something of a steer from Treasury and from the Treasurer himself.
Yeah, look, that's right, Ross. I think we should expect to see the RBA raising rates yet again at its meeting this week. I had been looking for a very strong 75 basis point rate hike. Look, I don't think the case is there, that we didn't get a smoking gun with the Q2 CPI. Turned out to be a little bit softer than I had expected. So, look, I think we're going to get a 50 basis point rate increase. That, of course, is a very big rate increase, but not in line with what we've seen from the RBA previously, and not an outsized hike.
OK, one other aspect of this is I notice money markets really have pushed bond yields well down. Money market interest rates have come down this week. Stock markets have rallied on the expectation that there is really a chance of the soft landing and really that interest rates might not have to be as aggressively raised as what was first feared.
Yeah, look, I'm not convinced we're at that sweet spot just yet. Yes, it is entirely the case that Q2 CPI is a little bit softer than expected, but when you look into the details, we can see that subsidies and suspensions played a bit of a role. So we know that the voucher program that state governments have been running, when the statistician calculates costs that hit household sector, they take that off. So that contributed, I think, to that softer print. Those subsidies, those vouchers aren't going to be there in coming quarters. We know that the fuel excise tax is scheduled to come off in Q4.
And indeed, we've just heard from the Treasurer saying it's coming off. There's no ifs or buts about that. He says, I've been straight all the way along. It's coming off. So it's gone.
Yeah, look, and I think that is the right approach from the government here. But indeed, that does mean higher inflation. So, look, I'm not comfortable yet that we have this thing tackled. We're going to see higher inflation. The RBA still has a significant challenge on its hands. And I think we should brace for the cash rate to go quite a bit higher yet. OK,
so there's one other aspect of it that's in the current quarter that wasn't in that previous quarter of inflation, and that is about energy prices. The big increases in gas and electricity are still to flow through our economy. This is why there's no let up on the inflation rate. That's why you get the sense that they're seeing it peaking out somewhere above or just below 8%, as it were.
Yeah, that's exactly right. So we saw over the past quarter that the wholesale price of gas and electricity spiked significantly on events in Europe. That will feed through. It's not there yet in these numbers. So that's another thing that's going to add to inflation. It adds to cost of living pressures for households. But of course, for the RBA, it also means inflation remains above target for longer.
Well, if you say that the Reserve Bank raises rates by 0.5%, that means they've come pretty rapidly from 0.1% to 1.85%. So it's a pretty steep sort of increase in rates. But at what point do you imagine that they pause and wait and see what the impact is, that they don't overdo the rate cuts? There's a point at which they do stop and pause.
Yeah, look, I think so. I don't think we're going to see that pause until the end of this year. I actually think the RBA is going to keep hiking at every meeting for the remainder of 2022. I think we're going to get up to 3.1% cash rate by the end of this year. I think that is potentially when you get a pause. At that rate, I think policy is outright contractionary. So genuinely leaning, if you like, against activity. I think at that point it would be sensible. At that point, it should be sensible to pause. We should at that point have seen, by the end of this year, we should have seen the peak in terms of those inflationary pressures. Potentially, that should be enough for the RBA, but we're not going to see a pause anytime soon, I don't think.
And what about the US Federal Reserve this week? Because obviously, as we've explained, that increase of 0.75%, many thought it might have gone up by 1%, but that tends to lead interest rates in other parts of the world. As we heard from Jim Chalmers, his fear is A, that the forecasts are wrong, and B, that we get some imported knock-on effect from either the United States or what takes place in Europe.
Yeah, look, I think we should be a little bit grateful, perhaps, to the Federal Reserve for being so aggressive on the policy front. By constraining US growth, potentially seeing a significantly weaker US recession, that will mean that global price pressure is a little bit softer. So, as we have done plenty of times in the past, it's an opportunity for Australia to come in potentially on the back, if you like, of tighter Fed policy and have a less of a challenge in terms of our own inflation fight here in Australia.
OK, so it was said right at the beginning that somehow Australia was a bit different. Now, Australia has proven to be a bit different. The Reserve Bank Governor Phil Lowe had said that. He believed that we wouldn't have the same inflationary pressures. As it turns out, we have inflationary pressures, but they might not be as great as some of those seen overseas. But as Jim Chalmers says, it doesn't matter what happens overseas, you're still going to feel it here in Australia, and that's the reality. But, it may very well be that, all things being equal, Australia might really avoid a significant and sharp downturn in the economy, notwithstanding next year or the year after, the economy is only forecast to grow by 2%.
Yeah, look, that's right. And to be fair, the Treasurer's own forecast that he released yesterday, or released last week, suggested that is exactly right, that we're not going to get a significant rise in the unemployment rate. I think the Treasury is now looking for the unemployment rate to go up to about 4.25% from a 50-year low of 3.5%. If we look back over history, that's a pretty low unemployment rate. So look, certainly the case that there are grounds for optimism that we should be able to get a soft landing here in Australia. But my sense is that is going to require the RBA to move aggressively to get inflation back under control. We do need to, I think, brace for a higher unemployment rate. That's part of the solution, if you like, to getting lower inflation. But potentially, if 4.25% turns out to be the peak, if you like, of the unemployment rate this cycle, that's pretty good.
Remind me, on Tuesday, Reserve Bank Board makes its decision. What do they do?
50 basis points, Ross. So I think we're going to get a 50 pip hike. Now, in history, that's a big hike. Looking around the world, it's perhaps relatively mild. The Bank of Canada hiked by 100. I just don't think the case is there for anything like that. A 50 pip hike from the RBA on Tuesday.
There you go. Deutsche Bank's Phil O'Donoghue. Always good to have in the program. Many thanks for your time today.
Thanks, Ross.
Coming up after the break, we'll move away from the economy, but not from interest rates, with a panel of mortgage challengers using tech and speed to pinch market share from the big banks. Thanks for being with us here on Business Weekend. Well, in Australia, home lending, including for investment properties, is worth just under $2 trillion. Of that, the big four banks account for around $1.5 trillion of it. They hold 3/4 of every mortgage in this country. But this week, something peculiar happened. Westpac said that by the end of the year, it'll start to improve home loans in just 10 minutes. The new weapon in home lending is speed, and that's being driven by new entrants that have used technology to their advantage. But do these new players have a future against the big banks? Remember, the neobanks Ginger and Volt have recently closed. So let's go to our panel. Alongside me, Andrew Walker, co-founder and chief executive of Nano Home Loans. Many thanks for your time. And in Melbourne, Derek Sheeran, chief executive of 1-2 Home Loans. And Derek, thanks for your time as well. First to you, Derek. I just wonder, ANZ was one of your original backers. Is it really tough to try and take on those big banks at their own game?
Yeah, we're very fortunate to have a great partner in 1835i, who's one of our chief investors, and that's the venture arm of ANZ. I actually think the market is really well primed now to expand really and see new entrants enter the market. The market has never been more ready for players to come in and offer transparency and ease. And I think there's more than enough room for play for everybody in the marketplace.
Okay, so Andrew, in your case, again, you got big banks. You can see the example of those neobanks. Now, they were deposit-taking organisations that have had to hand back the money and their licence. So is the same pressure there on the entrants in this mortgage market as well?
Look, there's a fundamental difference in the way the businesses are constructed. So the regulatory capital required to run a neobank is very high, and it's a really tough business model because you're competing basically in an unfair fight. Incumbents that have been there for 200 years have got big balance sheets. It's tough. Look, the digital entrants that are in mortgage origination are in a different spot. So for our business, for example, we actually partner with banks. So we're more of a platform company than we are a lender. We do both. But you would have seen AMP Bank, for example, are using our platform, and we'll have a few more out before the end of the year. So the market's changing quite quickly. Okay, so just explain to me Westpac's move this week, because it's not the only bank that's done this. Everybody's trying to get the need for speed, as it were. Why is it that speed is seen to be the key weapon in the new home lending mortgage market? Yeah, look, it's a global phenomenon, actually. So, look, speed is one dimension, but there's really 3 points in the triangle. So speed is a proxy for customer experience, and it's a proxy for unit economics. So let's unpack that. So customers are now used to living their lives online and digitally. Yep. They expect instantaneous answers on pretty much anything. And the customer experience they expect is aligned to that speed dimension. Now, speed being a proxy for customer experience, you need to be fast because the customers expect it. Now, unit economics are the other really important drivers here. So speed is a proxy for processing time and cost. Now, if you're taking the global average of 22 days to underwrite and approve a mortgage, that 22 days is not idle time, that's processing time and cost. So for example, the internal variable cost of writing a mortgage in Australia is around $3,000, which is a lot of money when you consider the margins that banks are running on today. So, Derek, when I come back to you, this speed, this quest for speed, is a 10-minute home loan approval, is that to the advantage clearly of the customer, but what about to the bank, to the lender itself, in terms of its credit quality?
Well, look, in my view, I think speed at the cost of customer understanding may actually be sometimes risky, right? We absolutely offer a real-time platform that can serve a customer without any touch in real time. However, if a customer doesn't understand what their needs and objectives are, or if we need to have a broader conversation about what they need to get done and what the right solution is for them, nobody wants to be dealing with a salesperson trying to close something in a couple of minutes, right? If you need more time, I think it's really important that we work at the right pace with the customer. So the way we view the world is that actually the key thing that we need to do differently is to compete on product and experience. So we offer a rate-reducing loan that helps the customer automatically receive rate discounts. But also on the experience side, I think speed is important, to Andrew's point. But actually, we use a video call experience, an immersive experience where we present back to the customer their details and pre-canned content to help them understand the loan. Because to your point about getting the right deal done, it's really important that the customer understands what they're getting themselves into and that they know what's going to happen into the future. So we think speed is really important, but not at the expense of understanding. Because I was going to go to the whole point of the Royal Commission. The Banking Royal Commission was all about the appropriateness of lending at that time. And of course, many banks were found to have fallen short of really giving due process. This led to, an enormous amount of extra paperwork that people had to fill in before they were approved for a loan after the Royal Commission. They were literally going through people, to the nth degree, where it became a pain. ANZ, in fact, got so slow, they lost massive amounts of market share in the home lending market as a result. So, where is the balance between trying to make certain you've got enough information from a person and then that quest for speed? I think it really comes down to your understanding of the customer. Like, some customers have done this thing 5 or 6 times before. They know what product they want. They know what they're trying to achieve. They're very clear on their income and their expenses, and they're very clear about what might be happening to them in the future that might change that. There's other customers who've only done this once or twice, or maybe not at all, and they just need a bit more hand-holding. So for me, I think what's really important in the process is just to understand what type of customer you're dealing with and to help them get into the right pathway. Sometimes that's a real-time pathway. Sometimes that's a slower pathway where you spend much more time coaching them through the journey. And so we just believe about right-sizing the experience for the type of customer you're working with.
Okay, so Andrew, then you've still got to have the situation where you do compete with big banks. Now, you know, I only a week ago was talking with Shane Elliott, the boss of the ANZ Bank. They're just taking over the Suncorp Bank, or they're trying to, and he admitted that it's a numbers game. You've got to have scale to be able to get the cheapest price out there. So how do smaller lenders therefore compete on this experience, on the speed, but then also on this whole situation of trying to get the numbers game right?
Okay, well, there's a fundamental truth in banking that you can't ignore, which is, in the long run, the person that's got the lowest cost of capital wins the game. Right? The math is math, and it doesn't lie. But to Derek's point, customer experience is very, very important. In financial services, the Royal Commission was arguably about the downside of bad customer experience and the forsaking of that for profit. And so we see the consequences of that. Now, we see the market playing out in a pretty interesting way. So, for example, we at one stage compete with the banks in our lending operation, but we've partnered now with a number of banks and we're building the technology for them. So we're seeing a market both here and with our overseas partners where we're doing the same thing. They're facing a choice now of, do I take the development risk, the time risk? Do I try to build this myself? It's actually pretty impressive technology. It's hard to build. Or do I rent that technology like I do with all my other platforms? That's our core of our business.
I'll jump in here because there's one other thing about the banks. The banks have had such big market share and they've had these legacy systems that everybody knows have been slow, cumbersome, costly. Mm-hmm. They haven't done themselves really any favours. They have almost exposed themselves to new upstarts who are faster, more nimble, and probably using better technology.
Yeah, well, look, that's the core of our business. We've built the technology. It's world leading, and now the banks are actually leveraging the build that we've made to deliver this customer experience. That's how platforms work, and that's our business. Look, you know, oligopolies are great for economic stability and really poor for innovation. Technical debt creeps at the margin. You're thinking about your budgets, and it's actually easy to think, well, market share and flow will come to me by virtue of market structure. Why would I spend a marginal dollar to try to get no marginal excess rent, I guess you would say? And over a 20, 30-year period, that's why you end up with an ageing technology stack and a problem. And that's great for companies like ours because ultimately it gives us the opening to innovate, move faster, develop better technology, and then partner with the incumbents to deliver what they actually can't.
And I was going to say to you, Derek, is that the ultimate end game, that the big players just actually buy you guys out, or they've helped to fund you and set you up? Or is it a case where you can build market share against them? Because after all, if they've got margin in this business, they quite clearly have something to protect.
Look, for me, I think the game is to really build market share. We're also looking to partner with banks and actually other industries to offer our technology as well. But really the first thing to get right is building a great customer proposition and building market share. I think the answer to your question around how do you compete is really down to not competing on the same terms. I mean, the big banks have what they call front books and back books, where they charge different customers different prices, and they actually have to manage their balance sheet in a very particular way. I think the new entrants don't have to offer the same products or play by the same rules. And I think by offering product differentiation, different products like a rate-reducing loan and doing things a little bit differently, it's more than possible to build a great business in Australia in partnership with the banks in some ways, and in other ways just going alone and doing your own thing.
Well, I'll tell you, it's going to be fascinating. We'll keep an eye on this and we'll come back maybe and explore this space again in the future. Derek Sheeran from 1-2 Home Loans and also Andrew Walker from Nano Home Loans. Many thanks for your time on the program today. Coming up after the break, we preview the profit reporting season and the New South Wales Productivity Commissioner explains why rules that were changed to make life easier during COVID should now stay in place. Great to have your company here on Business Weekend. Well, many of the rules imposed during the COVID lockdowns clearly were draconian. One of the positives is that some rules and regulations that were eased actually made life a whole bunch easier. Some of those rule changes are likely here to stay. This week, the New South Wales Productivity Commissioner, Peter Arctestraat, put out a report noting that the savings could be worth more than $3 billion over the next 10 years. I caught up with him earlier this week.
Well, there are a large number of changes during the COVID period which were more deregulatory, which were allowing business to get on with things, such as we were allowing electronic voting on strata titles, Zoom meetings, we're allowing electronic signatures, we're allowing delivery of alcohol by takeaway. All sorts of rules in relation to that. And to a great extent, they help businesses to get through, some businesses to get through the pandemic.
OK, so therefore, as a result, is that a reason why those laws should stay? Just because we've done it, why would you not revert to the way in which things were previously?
They worked well during the COVID. We now evaluated many of those and we concluded that many of them should continue the relaxation. Some of them had to be tweaked, Ross. Some of them were appropriate during the COVID, for example, building on Saturdays, which the community accepted. That's one which maybe won't continue in the future, right? But other ones will continue.
OK, so one of the issues about COVID, I guess, is that people felt as though liberties were taken away, privacy was compromised. But what you're saying here is that the relaxation of laws is actually about improving the quality of life, improving productivity, making life easier. And the classic example of that, I guess, and you just raised it, it was the Zoom meeting, the working from home. This changed the culture, the way in which we actually operate.
Absolutely. It changed the culture and it did improve productivity. Now, productivity is not just a buzzword, it's just not an economic term. Productivity affects every individual in society. It affects the newest born child to the oldest pensioner. What productivity is the amount of goods and services produced per person. And if the amount of goods and services produced per person increases, then the quality of life, the standard of living can rise. But we were concerned during COVID, if the amount of goods and services produced per person went backwards, that could have a negative effect on standards of living and the quality of life.
OK, so I'm starting to think about this because I get all sorts of people, business leaders sitting in your chair, crying out for productivity improvement. Jennifer Westacott from the Business Council. Australia needs to improve its productivity if we're to get real wage rises, all this type of thing. But what you're seeing is improvements in productivity that have come as a result of the pandemic, not because of big things that have changed, but because of small things that have changed.
Absolutely, Ross. Lots of little small changes can add up to a big thing. I think we all know the stories of Don Bradman. Don Bradman scored lots and lots of runs, over 6,000 test runs. He only scored 6 sixes. He only scored 6 big runs, but he scored lots and lots of ones and twos. And that's why our report covers lots of little issues. People might say, oh, well, having Zoom meetings for strata, having electronic signatures, it's all small stuff. Yes, it is. But if you add it all together, it comes to over $3 billion over 10 years.
Because one of the things that's also noted is that for more than a decade, Australia's productivity has gone backwards. Is this almost a blueprint as to how you get Australia's productivity, its production per person, as you point out, to go forward into the future? If it happens to be that you don't have to get on public transport or get into a car, that you can have the meeting from home, if you can, say, for example, get something delivered at the right time that suits you, these things improve productivity.
Absolutely, Ross. And when you use the term blueprint, you're absolutely right. The way that these regulatory reforms were done is new. We call it Reg X, which is regulatory experimentation. So a lot of things, these deregulations were implemented very, very quickly, probably without the level of analysis that would have normally been done in the past. So with the Zoom meetings and the electronic signatures, a lot of that was done quite quickly. Regulation experimentation. And we believe that's probably the way that we can do a lot more regulatory reform. We don't necessarily have to spend 4 years pontificating on what should be done. Let's just get in and do it with the community and business support. During COVID, we had a lot of business and community support to deregulate. Before COVID, I don't think you can imagine people allowing supermarket trucks to be delivering toilet paper at 3 o'clock at night. They would not like the noise, right? During COVID, I think everybody said, look, let's think about this. Let's think about this. And as it turns out, the trucks today are probably not as noisy as the ones that when the law was first implemented.
But because it gets me to thinking that Australia has right now almost record low unemployment rate, 3.5%, as low as it's been in almost 40 or 50 years. We've got participation rates higher than they've ever been. That women in the workforce, there's more than ever before, which is a good thing because you don't lose skills. So all of this means if work is made easier as a result of improvements in productivity, as a result of the improvements of deliveries of groceries, as a result of the ability for people to work more easily, that actually improves the society and improves Australia's productivity.
Absolutely. As you say, we do have record employment, we have record participation, but more can be done. And that's why the benefits we're learning from the COVID, we want to extend further. Because it's not just a business deregulation, it's not just digital, it's also flexibility for employees, for example, for the changes that were implemented for long service leave. We'll recall long service leave was introduced in the 1860s, very relevant then, and under those situations people wanted to take 3 months leave after 10 years to go back to Europe to visit, right? And that they needed the 3 months to do that. What we found during the COVID was that if you had to take large slabs of time off, say 2 months, etc., it wasn't as flexible as taking smaller ones. So the workers who did not have any sick leave or annual leave could have been in a pretty precarious situation. So they were allowed to take smaller amounts of long service leave, and that protected them, that helped them in the job. It gave the employers a little bit more stability so that the person didn't leave the job, etc. So that was a real bonus, and there's a real productivity gain in people being able to take some of their long service leave in shorter chunks than they used to.
Peter Archdestrak, very good to chat to you today. The Productivity Commissioner of New South Wales. It's such a good conversation.
Thank you very much, Ross.
From tomorrow, the start of August, it's the profit reporting season. And for many companies, it will be a big test of patience for their investors who have been hammered in the first 6 months of 2022. For the chief executives, their outlook is going to be vital. Junbei Liu is the lead portfolio manager for the Tribeca Alpha Plus Fund and joins me now. Junbei, always good to have you on the program. Many thanks for your time. This is really going to be very difficult, given the very variable outlook for the economy, for commodity prices, for our currency. It's going to be difficult to predict where your profits will be next.
Absolutely. And I think for investors, the outlook will be the key. Companies will be scrutinised or will be questioned a lot about what they're seeing right now. So trading update will be very important. You know, most of the retailers will probably give a trading update. Still, it is too early to tell if there's any signs of slowdown. But I would say that a lot of companies will be very cautious because, quite frankly, they themselves are not sure at this point.
OK, because one of the points about it is this is the period to June. From January to June this year, even though the storm clouds were there about rising interest rates and inflation, most companies were flying. We've had 6 consecutive months of record retail sales. We've had strong commodity prices during that period of time. We've had a dollar that's been falling during that time. These are all good things for company profits.
Absolutely. We're looking at close to 15% profit growth for this reporting season. And I think you're right. Everything's gone well for those businesses. Now, the question is, when we talk to, for example, the retail, we know things will slow down. A lot of elite indicators like consumer confidence, like the web traffic data, they all have fallen quite sharply in more recent weeks. Now, you know, are company going to comment on that? I think they're going to be just a little bit more cautious on what they're seeing. But whatever it is, you know, all these companies are going to talk to big dividends just because they've been awash with cash. Potentially there's M&A. And also it'll be interesting to listen to some of the, I guess, the tech companies on how things are going from that perspective.
Because many of Australia's leading companies in this last 6 months or so are down by 15 to 25%. And so there's an issue where they're saying the outlook is so poor for those companies that the share prices have come off. Now, admittedly, that's off record highs. But the truth is that now you're starting to see, as interest rate markets now turn around, on the expectation that maybe rates won't rise as much as they could have, interest rates are starting to fall. Stock market's taking off at a time when people imagine that it probably should be doing the opposite. So it's a converse thing that people are going to get their heads around.
Absolutely. You're absolutely right. Share market always look forward 6 to 12 months, always trying to anticipate what is to come. So by March this year, share price started falling all over the place. It's because people thinking recession is further down the track. So share price actually reflect the slowdown. So it's never about how you feel today. It's about what is expected tomorrow. So our view is that things will get a bit better for the share market because interest rate expectations coming off and potentially we're not hitting that recession, sometimes further down the track, and we will be okay. And at the same time, our corporates are very strong. Earnings growth is strong. Next year, we're still looking at double-digit growth, which is still above the trend compared to the past decade. And we're going to see very big dividend payouts. And also, the corporate balance sheet is very, very strong at this point, same as consumer balance sheet.
So are there any sectors or any companies that you're particularly looking at the moment, hoping that they might overshoot in terms of, because those companies that do surprise on the upside, quite clearly they're going to get a big bounce out of the back of this, and also some that aren't as bad as many might have anticipated, they're also going to get the bounce, aren't they?
Oh, absolutely. I think that in terms of the growth company, you should be able to expect some of the big price moves. They've already seen it this month on the valuation re-rates, but if the result actually hit expectations, I do think there's a lot of upside for those companies. We're already seeing WiseTech came out, already told the market things are actually going better than expected, and share price have rallied significantly. We expect the others likely to come through. We're already seeing a result coming out of the technology one, and those Euro things are pretty good. We think the likes of healthcare companies will do quite well because their share price lagged as well, and then the earnings going to be expectations. So all of those growth space, we do see a bit of upside coming through expectations. Resources is an interesting one. We do think that dividend is going to be the big driver of the share price, and the outlook is really very much China dependent. Not much they can tell you about it.
That's right.
One important thing this reporting season is insight into labour availability and labour cost, because this is something that is not going to go away, and see how our corporates are managing with that at the moment.
Jim Chalmers, always good to have in the program, giving this great insight into this August, this profit reporting season from Tribeca Investment Management. Many thanks for your time.
Thank you so much for having me.
There you go. Jim Chalmers wrapping up the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday, but don't forget, you can keep up to date with all the latest business news with our daily program, Business Now, 4:30 and 10:30 p.m. Eastern Time. And don't forget, you can find our program and plenty more finance news on our website, skynews.com.au. Thanks for your company today. I'm Ross Greenwood. We'll see you next week.